Very good morning to everyone, and a warm welcome to this first panel of today's AIM Summit. I'm Alastair Sewell. I was, in fact, the head of our fund and asset manager rating business. I have just this year, in fact, transferred to be a group credit officer, responsible for ensuring that our ratings on financial institutions in my region are correct. And quite a time to become a credit officer, with the looming risks of stagflation, with the Russian invasion of Ukraine, and many other risks on the agenda. It poses unique and evolving challenges for investment managers. And of course, in that context, diversification, the only free lunch in finance, is possibly the solution to the ails that face investors. Now, joining me today, I have, frankly, an embarrassment of expertise on the panel with me. Esty, if you'd like to introduce yourself very briefly.
Sure. Very briefly, I'm Esty Dwek. I'm Chief Investment Officer at FlowBank, a new up-and-coming, growing Swiss private bank that's entirely digital. I spent quite a few years at Natixis Investment Managers and HSBC before that, and I'm delighted to be opening this summit with our first panel.
Esty. Jim.
So Jim Barry, I'm Chief Investment Officer of BlackRock's alternative asset business, which is about $330 billion of all the usual food groups. My own personal background's in infrastructure investment, been investing in particular renewable energy for almost 25 years, so finally becoming trendy. And outside of that, I'm from Cork in Ireland, and that's important because everyone from Cork is afraid you'll think he's from Dublin. So with that, back to you, Alastair.
Thank you very much, Jim, and thank you, Esty. So, as of about 6 a.m. this morning, an investor could earn 24 cents on the dollar from investing, yield of 24 cents on a Japanese government bond. So I guess my opening question for the panel is, at long last, investors are getting paid to hold traditional assets. You can buy a bond, it'll pay you money. We'll get onto inflation. You can buy equities, it may do something for you. So my question is, what is wrong with the 60-40 portfolio? Has the 60-40 portfolio come back? And what is the role of alternatives these days? So, Esty, are alternatives dead?
No, I certainly hope not. That would be a big downer to start the panel with. There are a lot of questions about the 60-40 portfolio, and one of the big challenges that we've had recently is the increase in correlations between equities and bonds. I've got to be careful what I say, but the bonds haven't necessarily been doing their jobs in protecting your portfolio in times of equity volatility. So I think, if anything, that correlation can change and it can evolve, and I think it's too early to say that a 60-40 portfolio is dead, but you certainly have that need for alternative investments, even if your yields are coming higher again.
Jim.
So I think the 60-40 portfolio has been dead for a long time now, and I don't see the change in market regime, changing the circumstances. I mean, last year, and this is one set of data from, I think, Preqin, but 2.75 trillion was accumulated to invest in private markets. That's up from an average of 1.75 over the previous 3 years. So our clients, the people with capital, are making the decision to allocate. I don't think fundamental shift in where we are is going to change that. And I think that Esty talked about portfolio diversification. We can come back to that as a topic, but the question, in particular private markets, brings that diversification. The right hedge funds will also, and their role is to, bring you that diversification in your portfolio and not have you correlated with beta. But I think the reality is, as you touched on, the nominal rate or yield on the yen bonds to start with. We've seen a material move in nominal rates, in effect. But there's a real question as to where's the real rate. And I think that, as you think about alternatives in the mix, I think they will always serve the ability to deliver you a premium without the volatility over the market, on a risk-adjusted basis.
Thank you, Jim. So, very good news there, I think, for this summit, that alternatives are not dead, and alternatives have a valuable role in portfolio construction. But then let's get more onto the details of portfolio construction. And I guess the question is, if we start very big picture, what is the right allocation for alternatives in a diversified portfolio, Esty?
I mean, that is going to depend on so many things, on your profile as a client, on your time horizon, on whatever risk and return objectives you have, how much volatility and how much illiquidity you want to take. I know we're going to talk about that a little bit later. I think what we're seeing here is that your traditional assets aren't giving you enough, or they're not making the portfolio whole, and you have to fill the gap with alternatives, and that's where those come in. Whether that represents a third of your portfolio or a lot more if you're running an alternatives business, that of course remains to be a question, but the fact that they are needed to round out the portfolios, I don't think is in question. There's obviously, I know we're going to have a conversation on crypto. There's a lot of that as the new alternative in the conversation. But I think thinking that your equities and bonds can be your entire portfolio is just too simplistic today and doesn't address the reality of the complex environment we're navigating.
Jim, anything you'd like to add to that? And thinking in particular about institutional investors, over the longer horizon.
The more illiquidity you can handle in your portfolio, the more alts you should have. Particularly, let's make that comment around private markets. I think that there's no question they have proven themselves through cycles now, and particularly global financial crisis on the negative. And I'd almost say private markets are the assets for all seasons. And so, if you can handle the illiquidity, and you've got to do the analysis in terms of your obligations as an institution, then you want a lot of it. We'll come back to liquidity, because not all liquidity or illiquidity is born equal, but certainly that is key. The other area, I think, becomes hugely relevant in the current environment, where we have very substantial macroeconomic uncertainty and clearly moving into a completely new regime with embedded inflation, maybe not at the rate it is now, but certainly ahead of where it's been in the last 20, 30 years, but also with a monetary regime fit for that context. And so it's really important to be playing into real structural shifts that are on the way, of which decarbonization we can come back to, decoupling China, United States, what that means for globalization, and I can go on, whether it's tech or healthcare, whatever it may be. Private markets give you a way of getting much really precise access at scale to some of these structural shifts, and I think that any investor needs to be thinking about their portfolio in that context.
So you mentioned inflation there, Jim, and maybe I'll come back to you on this one, Esty, but inflation is dominating the narrative at the moment. Inflation is clearly a concern for investors, but where in your mind, where are the inflation hedges in the alternative markets, and where can investors go to manage that risk?
Well, I think as Jim was saying, you have the private markets that you're giving up some liquidity, but that means that you're kind of navigating that cycle. You have the ability to look through a long period of time and a more volatile period of time with the eye on what you're going to get at the end. So I think that's certainly one way if you have that time horizon and you want to just look through the next 6 months, 12 months and just think 3, 5, 7 years out. Obviously, real estate is often seen as one area that can work as an inflation hedge. Others that are meant to be inflation hedges, like gold and like crypto, haven't worked quite so well. Recently, gold had a nice little run for a while, but seems to have stalled a bit with rising real yields. And of course, it's been a difficult couple of weeks for the crypto market. So that one of the problems we've had recently is it felt, I think, from a market perspective, there weren't a lot of places to hide. And you can feel that, I think, again, in the more liquid markets, that you can feel that weighing on investor sentiment.
Indeed, it was in fact the worst quarter for bond returns on the Bloomberg US Ag since records began, which was 1999, so put that in context. Jim, and we're going to come back to cryptocurrencies. I'm dying to ask you about Terra, so we'll talk about that in a second. Jim, inflation first to you.
Yeah, so as Esty said, I mean, real estate has kind of a long track record of giving you inflation exposure. I think you have to be careful with real estate at the moment. I think this 2 years of pandemic has been a massive global social experiment, and I think it's changed the way we think about space and how we're using space, whether it's central business district, whether it's at home. It's changing the use of space in the commuting system, as we're not going to have the same volume of people coming back to work every day in the manner they did pre-pandemic. So as we think about inflation, understand there's structural dynamics on the way, still uncertain, but certainly as an asset class, it's proved its mettle with respect to inflation. Infrastructure, which is now very large addressable investment opportunity for individuals and institutions. Also has either implicit or explicit inflation exposure. A lot of contracts and things like public-private partnerships will have explicit inflation escalation in the payments, but certainly another asset class to be thought about. And then a lot of the private credit space, direct lending, is floating, and so indirectly we'll get exposure to the sort of correspondent monetary policy associated with inflation. So, right across the board, you can think about inflation and hedging through private markets.
Absolutely, but of course with asset quality considerations there as well in terms of pressure on underlying consumers.
You have to work with a manager like BlackRock who will absolutely only underwrite the best.
Very, very good, very good. Okay, now, cryptocurrencies have sometimes been touted as an inflation hedge, and indeed I did see just last week that someone launched an ETP backed by gold and Bitcoin, which struck me as a interesting choice. But the cryptocurrency market suffered some eruptions last week. Do you want to take us through those, Esty?
Sure. I guess thinking of where it started is not easy to pick a starting point, but when things really unraveled was when the Terra USD stablecoin that was meant to be pegged to the dollar by algorithms failed, basically, and dropped, I think, at some point to 24 cents on the dollar. Obviously, the Luna currency fell, and then the whole crypto market seemed to not all to the same scale, but really seemed to sell off very, very sharply. There are a few things that you have to keep in mind. One, there are a lot of stable coins that are physically backed, so you can't put them all in the same basket, although there's a little bit of challenging the tether peg at the moment as well. Obviously, the fact that the algorithms didn't hold isn't fantastic. It's added, I think, to questions about confidence, broadly speaking, in the crypto market at a time when you had a lot of retail investors sort of joining the party late. So not those starting investors that had been in there since 2012 or 15 or something that came in the last year or two and that really suffered quite sharply. So you had these very sad messages on a lot of boards. So you had this one event that really sort of spilled over into a lot of the rest of the crypto market. But there are a few things that you have to keep in mind. One, it wasn't just about crypto. We've had an indiscriminate sell-off across asset classes and, of course, across a lot of the high-growth tech names. And really, most of that had started with Netflix over a month ago. And so you already had that weakness and that weight. The other thing is, when you look at the crypto market, and there are plenty of experts who I'm sure will run you through this in other panels, it was interesting to see the resilience of Bitcoin principally and then Ethereum. And I think you're starting to see that differentiation between the different cryptocurrencies. So maybe the events of the past week raise some questions about the newer cryptos or the smaller cryptos, and certainly about these algorithmic pegs. But some people have said when you think of crypto, Bitcoin is like Bond Street, I guess, if we're in London right now. And so when you're trying to think, okay, it's very expensive, but what else should you look at? It's going to stay Bond Street, and that was also proven in the last couple of days. So I think there's a little bit of comfort that can be taken that you are seeing differences and they're not all moving together. Of course, they're not holding up great in the current environment, but withdrawal of liquidity and as we said, weak investment sentiment was a lot of obstacles for all asset classes.
So does that challenge the notion that cryptocurrencies, be they stable coins, be they Bitcoin, be they something else, does that challenge the notion that of the role that they can serve in a diversified portfolio, or the role that they can serve in terms of managing inflation risk?
We're at the beginning of a new period of high inflation. We don't know what is going to look like 6 months from now, let alone 2 to 3 years from now. And we're also at the beginning of this bigger adoption of cryptocurrencies, and even Bitcoin, if we want to take the biggest one. I think it's too early to start to rule out that it either is an inflation hedge, or it isn't, or it can't ever be again. we've seen obviously a very high correlation with the NASDAQ. We don't know if that is going to continue either. So, they're kind of feeding off each other at the moment. It's a new asset class that has been through big cycles, and we have seen big drops in the past already. The timing maybe was a little bit unfortunate, but I think across all of these questions, it's just too early to make those conclusions. And I think when you see, the amount of people we have here, the interest that there is for the crypto space, the adoption is continuing. And as that becomes more ingrained, I think the cryptocurrencies will be able to serve the purpose better over time.
And one of the points we've been wrestling with at Fitch Ratings is the extent to which cryptocurrencies and stablecoins can pose a systemic risk to the broader financial system. And I think to your point that it's perhaps too early to tell is also a function of size. And cryptocurrencies have a market cap of about $2 trillion of that. And this is before the crash, the most recent crash. Bitcoin of that was about 800 to 900, stablecoins about 200 or so billion. It seems too small for them to have really, really big spillover effects to financial markets. But as you say, there is a correlation, and that correlation with certain segments of the market is high. So, and maybe I'll turn to you now, Jim, on this correlation point. So cryptocurrencies sold off very strongly. Last week there were issues in stablecoins. Have you seen that feeding through to broader financial markes?
Well, I'm not sure crypto is driving broader financial markets. I think the general volatility and uncertainty in the broader markets is impacting crypto. What I would say about crypto is inevitably this will be regulated, okay? We can debate the forms, the type, who takes the lead, like Europe or not. But I think there will, experiences like last week where it hasn't delivered what it said on the tin, I think will push regulators to get more active. Concerned about that systemic risk, which is probably not relevant today, but where it might go. The other thing I would just put in the mix as you think about, the nature of the technology, this concept of state of work, which is Bitcoin, or versus or proof of work, should I say, versus proof of state, as these two sort of different sort of basis for validating your asset. The proof of work is massively energy intensive, okay, and that's just not sustainable. I mean, you're kind of opening up old coal plant to tie data centers to mine Bitcoin is not sustainable. And so, and particularly as you think about crypto being used as a payment exchange where you need huge volume and frequency of trading, it's a challenge. So I think the key point, this is new, it's got scale, and it's, inverted commas, liquid. And so I think that, of course, there's going to be interest in something like that, but so much to learn and know about this.
Now, I want to come back to the topic of correlation just in 1 second, but last question on crypto, Esty. Maybe you could just say a few words about digital asset custody very quickly, in terms of where people's cryptocurrency is actually held and what risks they might face from where they hold their cryptocurrency.
I think that's a it's a very big question to answer briefly on such a panel. I think, as you see across a lot of different asset classes, there's always a risk of scams. At the moment, it does feel that you have to be extra careful and selective in how you store your wallet, or whether it's private, and how you keep your keys. I think Jim alluded to the fact that regulation is coming. We knew, I think, it was coming. I agree that last week's events are going to mean that's going to get accelerated. The fact that you have more retail investors now means that there's a need for them to be more protected. So I think those questions are going to start to be clarified a little bit more. But ultimately, it's still a lot about doing your due diligence, and picking picking as safe a way to do this as you would for any other investment that you're making in your portfolio.
So an important due diligence element there. Okay, coming back to correlations. So Jim, I wanted to ask you about correlations. First quarter of 2022, horrible for fixed income. Role of alternatives in a portfolio.
I don't think it went well for
enhancing,
equities either. No.
That's true. That's true. So 60-40 really is long dead. Last nail in the coffin, perhaps. Now, the correlation, the diversification effect of alternatives. Talk us through that.
I had great fun in Q1 with my liquid colleagues as they kept saying, oh, it's only because you don't get your mark till March, you'll be dealing with the same. But private markets is different because when it comes to valuation, yes, you look at market multiples. Quite clearly a key component of any valuation exercise. But you also look at transaction multiples. And transaction multiples haven't changed dramatically. I'm in the market every day across all the private market classes, and there's been a slowdown in trading as you're seeing potentially a gap open between the seller and the buyer, but the multiples haven't changed dramatically in transactions, nor in the public markets. And so that's a sec. And then cash flows is the other. You value cash flows. So you just don't get that same volatility in valuation that you get in the public markets. And so I've already seen marks come in for March, and across private equity, including infrastructure equity, kind of maybe down 2%, 2.5% private equity. A couple of portfolios I've seen down maybe 3.5% on the privates. On the debt side, maybe 1.5% across the board. So you're just not getting that same volatility. It will have some correlation because ultimately, if you take private equity, a lot of exits tend to be into the public markets. But I think the big advantage private markets then have is you can choose your point at which to realize the investment. And so, you can choose not to sell now in this environment into the public markets if you're, say, in private equity. So there is just an inherent lack of correlation or a dampener on correlation in private markets by virtue of their nature.
Mm. So the diversification role of alternatives was functioning, was delivering in the first quarter. Okay. And Esty, on the correlation and the diversification point as well, what would you add to Jim's comment about it seems to be functioning so far? There is obviously some delay on the marks, but what would you add to that point on diversification and the correlation working?
I completely agree. I mean, that's one of the advantages of private markets, right? You're not going to have the same volatility, so you're going to have that diversification element that's going to stay throughout the cycle and throughout different regimes as we're going through at the moment. So that's really one of the big advantages. At the moment, that's the correlation between other or more traditional asset classes, and we can include crypto in that, is what's really challenging portfolios, right? When your equities and your bonds are moving together, there's no place to hide. When now we're starting to see just in the last week or two that your bonds are starting to do better as your equities continue to sell off. Your VIX was coming back down as well, despite your equities selling off. So maybe a little bit of encouragement that we are going back to a more traditional correlation environment. But I completely agree. It's one of the reasons why having those alternatives in your portfolios are important. You want to have as much guaranteed, and I use that word cautiously, as much guaranteed diversification in your portfolio as possible, exactly for periods like now that we have seen happen every so often over the last few years when everything else is moving in tandem, and you need to find those. So correlations change, they evolve, they're certainly not permanent. Private markets, due to their nature and to their illiquidity, tend to have those lower correlations throughout cycles, and I think that's those are the things you want to have, I'd say, throughout time in your portfolio, and then you want to look at these evolving correlations and look for what you can add to the portfolio for shorter time horizons as well.
Now, you both already alluded to the next big topic that I wanted to come on to, which was the topic of liquidity and the management of liquidity in alternatives. So obviously, when you invest in alternatives, you acquire an illiquidity premium. How significant has that illiquidity premium been to the broad asset class over the last few years?
Well, in the last few years, it was really helping to compensate for the lack of yield you were getting from your bond investment. So that was one of the reasons that drove a lot of institutional investors, particularly insurance businesses, sovereign wealth funds that needed to hit those yield targets to increase their private market allocations, because you were getting that income and you got that premium. You knew you were giving up some liquidity, but you were getting those income numbers that you absolutely needed to take care of your investors. So that was really one of the key factors and drivers of the last couple of years. Now that your yields are higher, and assuming you've been in cash and you didn't suffer through that move in yields, then the picture looks a little bit different as well, right? If you're getting close to 3%, I know we're below it today, but on your US Treasury yields, that consideration compared to your equities and compared to some of those private markets can change. And so you're going to need that premium to continue to evolve. And of course, Jim can talk to that, but in some of the asset classes, you have quite high valuations already. So you're going to have to keep an eye on those as well. But in recent years, it's really been a question of finding that source of yield and adding those to your portfolios, and that's where that illiquidity premium really did its job.
Absolutely. So, Jim, question on valuations there.
Indeed, valuations. But over time, it's shown. I mean, look, the lower the risk, the less the premium. If you look at something like infrastructure debt, which was, that was the best pupil in the class through the last 2 years, in terms of the resilience of that asset, particularly due to its capital attachment point on a low-risk asset anyway. But there, your illiquidity premium is probably going to be somewhere between 30 and 150 basis points, depending on the nature of the asset. Typically, the illiquidity premium goes up with risk, probably averaging out in that 50 to 75 range. But then if you go into sort of corporate private equity, you're going to be, the data shows something like more like 400, 600 basis points over time as a premium. So again, you know, the statistical analysis shows the premium is there. I think much more important is that you work out what your need in your portfolio is. If it's income-based, then you're going to lean more towards the credit end. It's low risk, so the premium will still be very attractive on a relative basis. And if it's return you're looking for, if it's growth in your portfolio, you're going to lean towards the higher risk end, particularly into structured credit and then equity.
Mm-hmm. Now, of course, the flip side of the illiquidity premium is you're getting it for illiquidity, right? So, Jim, can you talk to us a little bit about what solutions there are for investors in terms of realizing liquidity in private markets?
So first of all, liquidity in our world, generally speaking, you know, is very fungible, right? Okay, it's not a black and white point. There's a lot of assets, even in my world, where you have liquid credit, where you know they're determined as liquid. It's in the label, but there ain't a hell of a lot of liquidity when you actually need it. And I think you know you see that in a lot of you know public market classes as well, particularly the higher risk end. And then what we've had evolve, particularly over the last 6 or 7 years, is real liquidity in limited partner stakes in funds. So huge growth in secondaries, and in a sense that you know kind of that mark has you know kind of ebbed and flowed a little, but basically now, if you're a sophisticated investor in private markets, you can reshape your portfolio very easily through trading your stakes in funds, which was always seen as the big negative. You had to wait for that long sort of J curve to play out over the life of the fund. And you know, for those buying, what they're getting is vintage diversification. They're getting sector diversification. You know, it's a very data-driven game on the buy side. But certainly, what you've seen is just much more liquidity in the illiquid space than it's been in the past. The other thing I would say too, I mean, the illiquidity, a big determinant of alpha in our world is knowing when to go for the door. You know, there was a situation up until sort of early this year, late last year, where in private equity, certainly if it wasn't nailed down, it was going for the door in the heat of all that sort of market exuberance. But the reality is you also have the ability to hold back. And so that choice of when you exit you know, at the asset level is a real driver of the alpha overall. But certainly, you know, your ability to shape your portfolio in the private market, illiquid space is much greater today than it has ever been before, and will continue to grow.
Interesting. We'll come back to that in a second. But Esty, in terms of managing the liquidity risk on a portfolio of alternative assets, how do you approach the liquidity dimension?
You know, I think you have to keep in mind what your ultimate objective is. I think if you're looking at private markets and you're looking at more illiquid assets, then I agree with Jim that there are a lot more options to come out than you would think when you look at the initial lockup periods that you might be looking at. But you really have to be prepared for that investment, and it shouldn't be, or it has to not be a concern anymore. You want to just think of the reasons why you're looking at it. I agree, infrastructure is probably one of the longest ones typically, but what you're seeing in the world today, when you're seeing the move towards ESG, when you're seeing the development of a lot of these new energy that require a lot of infrastructure investing, then you're ticking a lot of different boxes, and so giving up that liquidity shouldn't be a concern anymore. You have to be prepared to sort of give that up and not worry about it year after year because you trust in that investment. It comes back a little bit to that due diligence conversation we had.
Yeah.
It applies across everything. I mean, you're investing in these longer term deals. If you're going to be stuck, then you want to know what you're going to be stuck in. But if you're thinking that you want to have part of your portfolio that is this pocket of diversification, that is decorrelated, that is going to prove less volatile in tougher times like we've seen since the beginning of the year, then sort of naturally liquidity isn't your top concern anymore because you've already made that decision to allocate to less liquid elements, and you're getting the other benefits that you have from those asset classes. So I think it's more of making that decision that you're okay with having illiquids, and then it doesn't need to be part of the everyday conversation anymore.
Absolutely. But then with the backstop that should the time need, there are now increasingly available options in achieving liquidity in alternative investments. For example, I'd add onto yours, Jim, there's been the preferred equity trades that can be offered on private equity funds. We've even rated a few securitizations of portfolios of private equity funds, which I think speaks to the diversity of liquidity solutions which come about if they need to come about, if once an investor has changed their mind, essentially, about their allocation. Okay, with a few minutes remaining, I want to turn on to the last topic of our panel, which is ESG. Now, we've already alluded to some ESG considerations in private markets, but Jim, you mentioned about the energy consumption of Bitcoin. So I'm going to take that and I'm going to turn that to you, Esty, and ask you, in terms of thinking about cryptocurrency allocations, in terms of thinking about ESG, what is your thinking on at the moment in terms of the energy cost of something like Bitcoin, how that might change over the coming months?
It's certainly a concern for investors that really have an ESG lens across their portfolio. The intensivity of energy requirements for Bitcoin is clearly a challenge. We're seeing that Ethereum is moving to a proof of stake work, so we're going to have that. It keeps getting postponed, but it should happen this year. And
that will reduce the energy consumption?
According to some, up to 98% almost overnight. So you have big moves. You have certain cryptocurrencies like Solana that are meant to be ESG sensitive, I would say. So there is an awareness from the crypto space that they need to evolve, I guess, with the times and keep that in mind. Bitcoin at the moment is a little bit different. It doesn't look like it's going to change from the proof of work concept, but at the same time you have the Elon Musks of this world that want to make those improvements, suggesting using some energy from some of the Tesla plants to help power so that it would be basically renewable. So how feasible or how long that takes is a question, but there are thoughts around trying to make crypto more ESG appropriate, at least.
Mm-hmm. Which sounds like it needs significant green infrastructure investment to power all the cryptocurrencies, Jim.
Indeed. We need it for maybe other things before that, but anyway. Look, ESG as a private market investor is not a value-based judgment on what you do. ESG is a risk framework. And what it's really good at is identifying risks that don't have a price or cost today, but may have in the future, whether that's environmental, whether that's social, or whether it's governance. Private market investors are really good at underwriting costs and prices they see today in the assets or businesses they're underwriting. They're less well able or interested in trying to price something that may have a cost tomorrow. And I think one of the things that's brought home ESG as an investment sort of philosophy is that a lot of these risks are coming home today. We're seeing the cost of climate change measured in life and property in developed economies today, and that's driving attitude and ultimately policy, and is driving the decarbonization. And so if you're long fossil, however you're long it, you have to take that into account. It's not, do I see 10 to 15 years of cash flows today in private markets that I'm happy to underwrite and have confidence we'll still need that gas or oil going through that pipeline, for example, in 15 years' time. It's whether when I come to sell that asset or 7 or 8 years' time, will there be 10 or 15 years then? And there won't. Nothing like the same level. And so this is a risk you have to understand and have a view on as you write your check. And that applies the same to social areas. You know, increasingly corporations need a social license to operate, okay? It plays into their reputation. And so these issues that felt much softer and less relevant even 5, 10 years ago are coming home to roost. Governance we always understood at a level. So think about ESG as a risk framework that's fit for purpose for our environment. As for decarbonization, this is the greatest structural shift for our global economy that we've ever had to deal with in a pace of time that's mind-boggling. And so if you're not getting around that as it relates to your whole portfolio, then you're carrying massive risk. There's opportunity. It's not straightforward, to be very clear, and I'm sure you'll come back to that. There's a whole variety of risks available to you if you want to play into that opportunity. But fundamentally, it will reshape our world. And let's also be clear, you're going to have to deal with the cost of climate change. We've baked in minimum 1.5 degrees centigrade. As I always tend to say at these events, I wouldn't be buying anything at sea level on a personal or institutional basis. The reality is we're dealing with a massive cost of adjustment that's going to come home to roost.
Well, absolutely. I couldn't agree more with that last statement. In fact, we ran a study recently where we looked at the sensitivity of our portfolio of commercial mortgage-backed securities to assumed rises in sea levels. And you can see that it can be, over a certain time period, extremely damaging for the creditworthiness of those bonds. Now, we are starting to run short on time. So audience members, now is the time to start preparing your questions for our panelists. But I wanted to wrap up by asking both of my panelists to say a few words in terms of their outlook for private markets, for alternative investments. Esty, what is your outlook? What is the key thing, or the one key takeaway that the investors here should be thinking about?
Well, I mean, I think we've covered a lot of that already. You know, private markets, I think, are and should be an integral part of a diversified portfolio. I don't think the regime change is going to affect that, and it really shouldn't. Again, it's about, you know, selectivity, doing your due diligence, and really thinking about your objectives when looking more at these private markets.
Thank you. Jim.
So I think the public market volatility is going to drive a lot of transaction activity. I think the scale of private markets now is that your corporate treasurer or CFO, even if they're a listed company, is looking to the private markets as an option as it thinks about their capital funding needs. And so I think that, you know, kind of there's a whole raft of opportunity, you know, that will present itself in private equity and private credit. Infrastructure, you know, will play dramatically into the decarbonizing challenge. Again, one has to be very careful with infrastructure. You don't end up with risks you didn't intend, particularly indirectly through commodity pricing, power pricing, et cetera. So, but at the end of the day, massive growth in the addressable investment opportunity. And then real estate, you know, has a massive job to get ready for, you know, kind of decarbonization. A lot of assets not fit for purpose. Interesting play there. But I do think that real estate is dealing with this broader issue about its use. You have to be very thoughtful about it as you play in. But no question to my mind, as I said earlier, private markets is the asset class for all seasons, and this season is going to be very productive.
Well, there we go. We have an overwhelmingly positive vote of confidence in alternative markets from my panelists, who are both, of course, providers in the space. From my perspective, I think it's important to say it's interesting to see how alternative markets have evolved over time and how the availability of liquidity, how it's changed. You talked about it in shades of grey rather than being a black and white consideration, that private alternative markets provide diversification. They are more liquid than they have been. There are solutions out there. We are certainly entering into a new realm. So, with that, our time is elapsed, and it is time for questions. If you could ask, we have a question there, if you could say your name and who you're from, your company. There's a mic coming to you.
Nell McKenzie from Risk Magazine. So Mark Rowan from Apollo said that in the next few years, alternative assets will see 50% allocation in portfolios. I was wondering if you saw the opportunity to be this high, and if it would happen in the next couple of years, 50% to alternative investments.
So maybe I'll start with that one. When you look across the surveys that are provided of the institutional investor community, you can see a very common theme, which is to increase the allocation to private markets, to private equity in particular. So it seems clear that the intention is to increase the allocation. Now, I wouldn't want to put too fine a point on how much that allocation would be, but perhaps Esty or Jim, you would like to have a stab at that.
50 feels a bit high in the sense that I do feel that the equities and bonds do still have a role to play, but certainly the general trend is up, and no let up, as the numbers I expressed earlier would suggest.
60-40 perhaps? Esty.
I'm glad Jim answered first. I had heard 15, which I thought was already high, but 50 seems probably unlikely in the next few years, but I agree that the trend is upward.
Another question from the gentleman over there.
Hi, my name is Sanjeev Kumar. I'll stand. So I can relate to the private market a lot. And I think maybe this will become a bit controversial statement to make, but I realize because all my training is in the public market. That's how I grew up. But since financial crisis, I've moved more towards the private market. And my realization has been, and this is where the controversy might be, that the public market has become more of a gambling space. So people who understand finance feel more and more disconnected with the public market, the way the pricing is. For example, we operate a business, and because of that business, we are in the private market space. So you can find liquidity in the private market. It's just that you can underwrite deals the way you want them to be underwritten. The public market, the entire architecture that I see is kind of coming undone, and that's what's happening in the crypto market. I think this is a good crisis for the crypto market because I think there has to be some sort of marriage between the crypto world and the traditional financial world. I am a great believer of the private market. I would go as far as to say, 90% of my allocation is in private market. So what does that mean? It means that I'm more comfortable with the private market. I can relate to it. I can do transactions. And even in the current environment, you can get liquidity. It's all about knowing your counterparty, who you go to. We have infrastructure investment. We have a lot of complex investment. So my question was, the question that I was going to ask is, I see personally that some of the innovation from the crypto world could come into the private market. I just wanted to ask Jim if he thinks that way, because we are experimenting with some of the innovation on the crypto, from the crypto side, and seeing how we could put it into the private market.
So I see a lot of ideas around kind of using technology, whether it's crypto or other, to effectively tokenize the private investment and sort of make it more liquid. And it always strikes me, isn't that what the public markets are? And so, not suggesting we won't have kind of initiatives in that regard, but this is not the end of the public markets. The public markets, there's a regime change on the way. This is enormous in its significance. There's massive dynamics at play, inflation, monetary policy response, et cetera, which we're struggling to be certain about, where we've been dealing with an extraordinarily certain environment for effectively decades, but particularly the last 10, 11 years. And a lot of investors have only experienced that very sort of stable context. So very understandable to see the volatility we're seeing. But the public markets have proven themselves time and time again that they're critical in their role for the global kind of macroeconomic financial system. And so they're not gone. And in practice, the private markets need them because oftentimes, particularly in an area like private equity, it's to the public markets we look to exit. But look, I do think that your points about private markets are well made in terms of your ability to be more selective, structure your investments in a way that suits you, and manage the risks more specifically. But I think also the big thing is liquidity, right? Okay, with all these dynamics, ultimately you'll end up with a lot of the dynamics you have in public markets if you create a liquid trading of private market assets. So I'm not sure it's going to deliver that correlation benefit, portfolio diversification benefit you might look if you effectively create a market in the assets. Appreciating some of them may be structured quite different. So allowing for innovation, I'm sure we'll see some of that. But this is not the death knell of public markets at all, and I think that the reality is a lot of individuals and a lot of institutions can't take the illiquidity that comes with private markets, and you just have to understand that.
Thank you. Do we have time for another question? Question at the back, please.
Hello, Peter Hotovec from PHED Fund. So I have a question regarding how do you view the capacity of traditional finance or traditional funds in investment in cryptocurrencies? Because do you think that the understanding in traditional finance is solid or high enough? Just to elaborate, you talked a lot about the environment, the ESG, and its relation to crypto. So in my opinion, a lot of the traditional finance view ESG as more important than the tokenomics of the coin. Just a nice example is the Terra coin, which was heavily invested by funds. And how do you view? Do you think that there is a risk that the traditional financial system looks more on criteria like the environmental compliance or the sustainability, and forget and don't understand the basic tokenomics and conception of how the chain works? So I hope I made it.
Thank you. Thank you. Maybe starting that from a mutual fund perspective, we see increasing trends, or investment funds. We see an increasing ability of certain investment funds to invest in cryptocurrencies. German pension funds, or German Spezialfonds, institutional funds, are allowed to, in certain cases, invest up to 20% of their assets into cryptocurrencies. And of course, these are the very same investment funds which are subject to increasing European regulation on ESG characteristics. So it's an interesting question to ask. And Esty, maybe I can bring you in on that. And I guess the question is on the understanding of cryptocurrencies in a broader mutual fund context, and then the effect of ESG.
Well, so I think from a regulation perspective, you're only going to have so much room in a traditional fund to add crypto, right? Traditionally, I think in most UCITS, you have that 10% bucket to kind of throw whatever you want in there. So that would limit your allocation. I think there's also a feeling that you want to know what's in your crypto bucket when you're investing in it in your portfolio. I'm not sure how much appetite you would have to have so much of a mix, or buy a more traditional fund and then have these crypto allocations rolled in. So I think that's a first bit. The second, of course, is the ESG consideration. I mean, now, especially in Europe, you have the regulation with the different articles in terms of ESG classification. I don't think crypto falls anywhere within that at the moment, at least. So you want to know what your objective is, and you want to know what your fund's objective is. And I'm not sure how much mixing and matching we're going to see, at least for the time being.
More questions? Question from the gentleman here in the third row.
Thank you so much for your contribution, very insightful. My question, Michael Sterling, I'm with Sterling Infrastructure Partners. The query I have is, are you seeing listed companies co-invest in alternative investments in private markets? Because that's something that we're seeing from a structuring perspective, where they are assessing whether they should invest into projects, either going onto the stock market or actually bringing partnerships in with private capital.
Jim, co-investments?
So, sorry, just to make sure I heard it. So look, what I'm picking up is like, how do we see people partnering with the GPs is it, in the private markets?
Listed companies with GPs, yeah.
Yeah. So look, first, I made the point earlier, to be clear, is that listed companies are now looking at private funding options in a way they never did before, okay? The private debt market has risen to a scale that it makes it relevant to listed companies, and particularly when there's volatility like we see, and we saw particularly April 2020, we saw really high quality lending opportunities as people went to the market, public companies went to the market for liquidity with all that uncertainty. It was before the monetary and fiscal sort of policy intervention had really taken effect, and we saw a lot of private lending into public companies at that moment, and I've no doubt with current market volatility, that'll be the play. And we've seen a couple of instances where some bond issues have been saved with some big private allocations in the mix. More generally then, I would say to you what we're seeing with respect to our client-based institutions and getting access to private markets, fund allocation is absolutely still core to kind of an investment strategy. But more and more clients are developing the capability to invest alongside their general partners. And we, in particular, have a team, the central team focused on co-investment, working with our biggest and best clients that have the capability. It's very important. It's not just about having the ambition. You've got to have the people and the processes to be able to play into the timeframes of transactions in the private market space. But basically, and that in turn allows you to take down bigger things. And so, kind of we were involved in this gas pipeline deal with Aramco in Saudi Arabia late last year into this year, over $15 billion. That was, kind of a mix of private and public, but there was a big co-investment dimension to that as, kind of global LPs played in with us as the lead manager.
Thank you. So I see that we are out of time. So if I could perhaps invite you all to join me in thanking the panelists today for their insightful contributions. Thank you.
Thank you.